Gear up for an electrifying Monday edition of the Tech Stocks Daily Podcast, where we're diving deep into the latest buzzworthy developments around your favorite tech giants trading on the NASDAQ. Today we spotlight Microsoft's big bets on AI with OpenAI and its strategic Azure forecasting, Google's user experience enhancements and regulatory hurdles, Xerox's standing amid financial anticipations, and Spotify's bold stride into price adjustments and audiobook expansion. Plus, we unpack the current market sentiment swaying between cautious optimism and strategic innovation. Get ready for a thrilling ride through the ups and downs, strategic moves, and market predictions that could shape the future of tech investment. Stay tuned for insights that could redefine how you view these tech powerhouses and their stock potential. In today's spotlight, we're diving deep into a flurry of news surrounding tech giant Microsoft, revealing its multifaceted approach to innovation, partnerships, and strategic investments that could reshape the industry landscape. Kicking things off, Microsoft's financial report card for the third quarter grabbed headlines as it was poised to showcase the tech giant's resilience and innovative edge amid evolving market dynamics. With its earnings call set for April 25th, all eyes are on Microsoft, especially its Azure cloud services, Office 365 suite, and the growing impact of artificial intelligence on its portfolio. The intelligent cloud and productivity and business processes segments were expected to be key drivers, reflecting the company's strategic emphasis on cloud computing and AI. In the realm of generative AI, Microsoft is not just a player, but a pioneering force, deepening its involvement with OpenAI, the mastermind behind ChatGPT. Satya Nadella, Microsoft's CEO, didn't mince words when underscoring Microsoft's role in OpenAI's ascent. His loaded statement, "OpenAI wouldn't have existed but for our early support," isn't mere hyperbole. The substantial investments totaling $11 billion between 2019 and 2021 underpin a strategic alliance where Microsoft couples its cloud infrastructure might with OpenAI's cutting-edge AI models, charting new territories in AI's application in businesses and everyday life. From the pursuit of advancing AI technology, we pivot to Microsoft's ambitious outlook on Azure, expected to rake in a striking $76 billion in annual revenue. Analyst optimism spotlighted Azure's growth, propelled by burgeoning AI workloads and OpenAI synergy, drawing a vivid picture of a sector on the cusp of explosive growth, fueled by AI advancements. Beyond these ventures, Microsoft's green thumb is showing through its investment in LanzaJet, a gesture amplifying its commitment towards sustainable solutions. Doubling down on sustainable aviation fuel and renewable diesel, Microsoft's backing aims at catapulting LanzaJet's revolutionary technology onto the global stage, potentially altering the course of aviation and heavy industry. Moreover, Microsoft's collaborative DNA is evident through its partnership with Cognizant, aiming to supercharge enterprise-level AI adoption. By infusing Cognizant's global footprint with Microsoft's generative AI and Copilot tools, they're setting the stage for transformative operational efficiency, not just within healthcare, but across sectors craving innovation. These collaborations and investments narrate a story of a tech titan doubling down on AI and sustainability, aiming to lead by example. The strategic knitting of AI across its product suite, coupled with a palpable push for sustainable technologies, highlights Microsoft's vision of a future where technology and sustainability intersect seamlessly. In essence, Microsoft's recent maneuvers reveal a choreographed effort to harness AI's transformative power, not just within its ecosystem, but as a driving force for the broader tech industry and society. Whether it's shaping the future of cloud computing, fueling startups with investments, pioneering in sustainable technologies, or reimagining enterprise operations through strategic partnerships, Microsoft is paving paths that could very well dictate the direction of innovation, sustainability, and digital transformation for years to come. The unity of its visionary projects and strategic investments under the banner of AI and sustainability underscores Microsoft's ambition to not just ride the waves of technological evolution, but to steer them. Today, Google finds itself at the center of multiple headline-making developments, showcasing its pervasive influence across different facets of the technology landscape. From innovative feature updates, strategic partnerships, to regulatory scrutinies, Google's activities today provide a comprehensive view of its ambitions, challenges, and its ongoing impact on both users and the broader tech industry. Starting with a significant update to the Google One subscription service, the tech giant has decided to enhance its offering by bundling Fitbit Premium and Nest Aware into the package. This move appears to be a strategic play to consolidate Google's services into an irresistible package for consumers, potentially boosting subscription rates. However, despite these enhancements, a glaring omission remains: the lack of a YouTube Premium add-on. As Google aggressively pushes its paid services like Gmail and Workspace bolstered by AI enhancements, the absence of YouTube Premium in this mix sticks out. Given YouTube Premium's popularity and utility, its integration could represent the final piece of the puzzle in making Google One a truly comprehensive service. This suggests a possible future direction for Google, as consumer feedback like this could drive further integration of Google's expansive service roster into a singular, more attractive subscription model. In a different development, Google's Circle to Search feature is reportedly set to receive a significant upgrade. The tool, which initially allowed users to perform quick Google Lens searches by circling items on their screens, will soon include options to save and share these highlighted sections. This not only enhances the functionality of the feature, but also points to Google's ongoing efforts to improve user experience through intuitive and innovative interactions. By integrating a copy image and share image option, Google leverages gesture-driven search capabilities to streamline content sharing processes, making information discovery and distribution more fluid and user-friendly. Furthermore, Google's commitment to fostering seamless communication was reinforced through a new partnership with Mio, aiming to provide interoperability between Google Chat and various other platforms including Microsoft Teams, Slack, and Zoom Team Chat. This collaboration highlights Google's recognition of the diverse ecosystem of productivity tools in use across industries and its intention to position Google Chat as a versatile hub for cross-platform communication. By enabling workspace customers to collaborate effortlessly across different services, Google not only enhances the utility of its own offering, but also acknowledges and adapts to the interconnected reality of modern work environments. Lastly, a significant development emerged from Japan, where Google faces regulatory scrutiny over its search advertising practices. The Japan Fair Trade Commission has pointed out that Google's advertising restrictions on Yahoo Japan could undermine fair competition in the advertising market. This issue underscores the delicate balance Google must maintain between leveraging its dominant market position and adhering to global antitrust regulations. While Google has cooperated with the probe and pledged to implement changes, this situation illustrates the ongoing challenges tech giants face in navigating regulatory landscapes across the world. Today's news encapsulates the multifaceted nature of Google's operations, highlighting its continuous innovation and expansion, the strategic efforts to enhance interoperability and user experience, and the challenges it faces from regulatory bodies. Each development speaks to different aspects of Google's strategy, expanding service offerings, enhancing user engagement through intuitive features, fostering open communication ecosystems, and adapting to regulatory pressures. As Google marches forward, these narratives will undoubtedly continue to evolve, reflecting the company's relentless drive to shape the future of technology. Xerox Holdings Corporation, a stalwart in the technology arena, particularly within the printing and digital document products and services sector, has garnered noteworthy attention in financial and tech circles today. There are primarily three angles from which Xerox's recent activities and performance metrics have been examined: its current stock performance relative to a key technical measure, an analysis of Wall Street's expectations for its upcoming quarterly earnings report, and a deeper dive into various revenue streams and their projected performance. Stock performance touchstone. Firstly, a spotlight shone on Xerox as its relative strength rating saw an uptick from 69 to 73, a noteworthy mention in the stock market's performance indices as provided by Investors Business Daily. The RSR is a crucial barometer for investors, ranking a stock's price performance on a scale from 1 to 99 against all other stocks in the database over the last 52 weeks. Achieving an RSR of 80 or better is often a green flag for a stock's potential climb, symbolizing its prime health and superiority within its industry. Although not yet at the optimal 80 or above bracket, Xerox's positive movement in this index suggests a growing strength or recovery, encouraging traders to keep a sharp eye for any forthcoming breakout opportunities, especially considering the market's current state of correction. Anticipated earnings report analysis. Secondly, anticipations hinge on Xerox's impending earnings report. Analysts have set the expectation bar at quarterly earnings of 38 per share, denoting an approximate 22.5% decline year over year. Revenue forecasts tally up to $1.58 billion, indicating an 8% fall from the prior year's figures. Despite these seemingly bearish forecasts, a nuanced layer is added by the upward revision of the consensus EPS estimate by 1.3% over the past 30 days, a hint at a possible shift in analysts' confidence towards a more positive outlook for the company. This sort of estimate revision is pivotal, as it often presages investor behavior and short-term stock performance, drawing a neat parallel to preceding empirical studies. Granular revenue forecast analysis. Beyond the broader financial picture, the fine-grained analysis into Xerox's diverse revenue streams, ranging from services, maintenance, rentals, supplies, paper and equipment sales to post-sale revenue, offers an illuminating perspective on potential growth areas versus challenges. The expectations set forth by Wall Street analysts outline varying degrees of growth or contraction across these segments, with a noteworthy projected uptick in post-sale revenue, hinting at robust service models that could counterbalance anticipated declines elsewhere. Market positioning and outlook. Adding to the technological firmament, Xerox has secured a formidable position, ranking number 4 among its peers in the computer hardware peripherals industry group, edging close to the upper echelons of its market segment. This ranking is demonstrative of Xerox's resilience and adaptability in a fiercely competitive sector, underscored by its persistent endeavors to innovate and refine its product and service offerings in alignment with evolving market demands and customer preferences. Conclusion. In wrapping up today's tech insights, Xerox Holdings Corporation emerges as a focal point of investor interest and analytical scrutiny, bolstered by its climb in stock performance rating, the cloistered optimism surrounding its forthcoming earnings report, and the mixed prospects across its diversified revenue streams. Amid these analyses lies the inherent narrative of a legacy company contending with the swift currents of technological evolution and market dynamics, striving to recalibrate its strategies and offerings for sustained growth and market leadership. Investors and technology aficionados alike would do well to keep Xerox on their radar as the company navigates these intriguing times. In today's tech scene, Spotify technology took center stage for a host of compelling reasons. This musical giant, beloved for streaming tunes into the ears of millions worldwide, is on the cusp of revealing its first quarter financial results. Analysts are keyed up, anticipating a revenue surpass of $3.9 billion, along with earnings per share sitting pretty at 78 cents. Comparing it to last year's first quarter, which revealed a revenue of $3.27 billion, the anticipation is palpable. Yet, Spotify has a recent history of playing a different tune than Wall Street's expectations, missing revenue estimates 4 times in the last 5 quarters. However, this hasn't dampened the mood. A significant factor stirring excitement around Spotify's financial reckoning includes the company's latest maneuvers, particularly a proposed price hike for subscribers. Tradition marries innovation here, as the price adjustment is seen as a pivotal step toward transforming Spotify from merely a celebrated product to a powerhouse business entity. Morgan Stanley analyst Benjamin Swinburne underlined this strategy, expressing optimism by revising Spotify's price target from $270 to $350, fueled by expectations of accelerated growth and greater clarity in market share gains and operating leverage by 2024. Furthermore, the charm of Taylor Swift has woven its magic into Spotify's narrative, propelling the company into the limelight through the Tortured Poets Department album, which not merely dazzled with over 1.6 million US sales, but also set the Spotify platform ablaze with more than 300 million streams. This synergy of art and platform showcases Spotify's market-dominating capacity to captivate and monetize audience engagement like never before. On the innovative front, Spotify's venture into audiobooks marks a notable pivot aiming at diversification and enhanced user engagement. A considerable segment of Spotify subscribers in the US has dabbled in this new offering, indicating a promising horizon for content consumption expansion beyond music. This paradigm shift is further evidenced by the manifold increase in additional purchases of audiobook listening hours in the first quarter of 2024 against the last quarter of 2023, demonstrating a resounding acceptance and appetite for varied auditory experiences within Spotify's subscriber base. Moreover, the introspection wouldn't be complete without a peek into Spotify's trading and investor sentiment. Despite the bullish outlook from analysts, the options market reflected a more nuanced sentiment with a bearish tilt. This polarity of perspectives underlines the high-stakes nature of investing in a dynamic sector like tech, where innovation, market positioning, and consumer loyalty play out in unpredictable ways. As Spotify strides ahead, its focus on artificial intelligence for enhancing user selection and experience denotes a keen investment in technology to stay ahead of the curve. As the company eagerly anticipates capitalizing on the tactical price adjustments and diversification into audiobooks, the world is watching. The seminal impact of the new Taylor Swift album also hangs as a promising prelude to what might chart the company's success in the immediate quarter ahead. Now, notifying all tech enthusiasts and Spotify aficionados, I'm turning the stage over to you. What do you make of these strategic expansions and pivots by Spotify? How do you see the price adjustments playing out in Spotify's favor, or do you perceive potential backlash? Share your thoughts, analyses, and predictions down in the comments section. Let's jam over this techno-musical convergence and forecast the tunes of Spotify's future. The overall market sentiment discerned from today's tech news spectrum swings towards cautious optimism, with a tinge of proactive adaptation across the tech landscape. Companies like Microsoft and Google demonstrate robust aspirations to harness and lead in AI technology, strategic partnerships, and sustainability efforts, signaling an industry poised for transformative innovation. With Microsoft's deepened stake in AI through its partnership with OpenAI and its anticipated revenue growth, particularly from Azure, there's a sense of bullish confidence in how AI investments could reshape the tech ecosystem. This strategic ambition is mirrored in Google's enhancements to user services and interoperability partnerships, aimed at enriching user experience and expanding its service penetration. Conversely, firms like Xerox, though showcasing a slightly improved stock performance relative to the tech market's demands, present a more mixed sentiment reflecting the challenges of legacy companies in evolving swiftly with the tech tide. Despite anticipated declines in earnings and revenue, the nuanced optimism in estimate revisions implies a belief among some analysts in the company's potential resilience and adaptability. Spotify's narrative reflects an embrace of innovation and strategic risk, particularly through its pricing strategy and expansion into audiobooks, underscoring a palpable expectation of growth despite past revenue misses. The excitement around its engagement metrics, bolstered by iconic album releases and product diversifications, points to a strong belief in the company's potential to secure and grow its market share. However, the caution in investor sentiment reflected in the options market suggests a nuanced view regarding the immediate outcomes of these strategies. In aggregating these stories, the day's market sentiment embodies tech companies' vigorous chase for innovation, scars draped in strategic adjustments and expansions aimed at consolidating market positions and opening new revenue streams. This manifests an industry landscape that is dynamic and forward-thinking, but not without its spaces of uncertainty and recalibration. The tech sector appears geared towards overcoming contemporary challenges by leveraging AI, enhancing user engagement, exploring sustainable solutions, and venturing into new markets. However, the cautious investor sentiments and regulatory scrutiny faced by giants like Google serve as reminders of the intrinsic volatility and regulatory landscapes these companies navigate. Overall, the sentiment is one of watchful optimism, balanced with strategic efforts to align with future market requirements and potential growth avenues. Today, let's zero in on Microsoft and explore whether it's a buy, sell, or hold based on the latest scoop. Now, diving into Microsoft's landscape, a couple of points jump out immediately. Firstly, Microsoft's financial third-quarter spotlight suggests resilience and innovation, especially with its earnings call eagerly awaited. Notably, its strategic partnership with OpenAI, a pioneering force in generative AI, signals deep investment in cutting-edge technology. Now, why does this matter? In tech, innovation is the golden ticket. Microsoft betting big on AI, particularly through its substantial investments in OpenAI, positions it at the forefront of a significant technological shift. Furthermore, Microsoft's steely focus on Azure, anticipated to rake in a whopping $76 billion in annual revenue, propelled by AI workloads, and its commitment towards sustainability through strategic investments, like backing LanzaJet, show a diversified yet focused approach to growth. These moves are not just fluff, they're strategic chess plays in sectors ripe for explosive growth, AI, and sustainable technologies. The partnership with Cognizant to boost AI adoption across enterprises is another feather in Microsoft's cap, signaling a drive towards making high-tech AI tools more ubiquitous in the business world. This is crucial because it's not just about creating technology, but also ensuring wide adoption, driving the bottom line. Now, with all this optimistic news fluttering from Microsoft's quarters, why might you hold your horses? Well, thriving on Wall Street is about sticking your ear to the ground and picking up on not just the good news, but gauging the overall market sentiment and external factors that could impact stock performance. Given Microsoft's aggressive push in AI, strategic partnerships aimed at sustainability and business innovations, the stock shines brightly on the radar for a buy recommendation. Why? The moves Microsoft is making today are fashioning the building blocks for what seems to be a promising future, potentially translating into significant growth, profitability, and market leadership. However, remember, tech investments, especially in giants like Microsoft, play a better long-term game. So, if you're considering this as a green signal to buy Microsoft stocks, think of it as nurturing a seed into a tree. But, and it's a capital BUT, always do your due diligence. All right, tech enthusiasts and savvy investors, mull over these nuggets of insight, and as always, ensure your investment decisions align with your financial goals and risk tolerance. Happy investing. Today's tech landscape painted a vivid narrative of strategic innovation, cautious optimism, and ambitious growth across key players like Microsoft, Google, Xerox, and Spotify. From Microsoft's groundbreaking AI initiatives and partnerships to Google's service enhancements and regulatory maneuvers, the tech giants are fiercely navigating the innovation frontier. Meanwhile, Xerox's mixed financial projections and Spotify's bold market strategies underscore the dynamic challenges and opportunities within the tech sector. As we witnessed a blend of AI advancements, strategic expansions, and regulatory adaptations, the overarching market sentiment leans towards an innovative yet pragmatic approach to future growth and industry transformation. Dive into the discussions, share your perspectives, and let's foster a vibrant community keen on dissecting and understanding the ever-evolving tech landscape. Don't forget to like, subscribe, and share this video to keep the tech conversations going. Be sure to swing by tomorrow for your daily dose of tech news, insights, and analysis.